Day subscribers, thank you so much for joining me today. I am Jeremy, this is the Financial Education Channel, and today we're talking all about dividends, building out a dividend portfolio. So many people only really like to invest in dividend paying companies. Why? Because you're basically almost guaranteed in income. Now with dividend companies, it's not an absolute guarantee. Companies can cut their dividends at any time they want. It just has to get through the board of directors and they can cut that dividend. So you should never see it as it's a for sure thing, but there's a lot of things you can look at that will basically give you tails that, wow, this company is going to keep continuing to pay dividends and maybe even pay out more in the future. The likelihood would be much higher than if they cut that or anything like that, guys, which is nice to get paid out from your investments all the time. You don't even have to worry about it going up necessarily in the short term or long term for that matter. Like if you invest in a stock at $10 and that stock just stays at $10 over the next 3 years, you don't make any money. But however, if it was a dividend paying company and let's say they paid you out $2 a share over that course of those few years, then you just made $2. So that's the nice thing about dividend paying companies. So let's talk about this and then we'll talk about how to actually build a dividend portfolio. So a dividend is a distribution of money, generally speaking, every 3 months. A lot of public companies, especially a lot of the bigger ones, they pay dividends of some kind. And the majority of them pay them out every 3 months, okay? They pay them out generally every 3 months. There are things that are called like special dividends that some companies do where they'll just pay it out a big fat dividend just randomly throughout the year. Sometimes usually, around October, November, maybe December, maybe if a company feels like taxes are going to change or something, they'll pay out a big special dividend. I remember, I think it was 2012, I believe, either 2011 or 2012, some tax laws here in the United States were going to change, and a ton of companies did big, huge special dividends because basically, the rates they were going to have to pay on that money that previous year versus the next year were going to be pretty different, guys. So sometimes companies do that, but the majority of companies are bigger ones and they pay it out every 3 months, okay? So if you're looking at a dividend company, like what do you want to look at? Well, first off, you got to figure out, does this company even pay a dividend? You can find that out basically in the investor relations page of any public company, or you can also generally look at like Yahoo Finance or CNN Money or CNBC or something like that. You type in a stock and generally if it pays a dividend, it'll say right there how much they pay as a dividend and what the yield percentage is. So, okay, awesome, they pay a dividend. What's next? Then you got to ask 2 questions. How long? How often, okay? How long have they been paying that dividend for? There are some websites, I know Yahoo Finance is one of them, where you can actually go to historical prices, and then you click a tab that says dividends only, and you can look at all the dividends that such and such company has paid out, how long they have paid that out for. You want a company that has a long dividend history of at least 5 or more years, generally speaking, because if they just started recently, who knows, they might just cancel it or something like that. But generally, companies that have been paying dividends 10, 20, 30, 40, 50 years, which there are some companies that have paid consistent dividends for over 50 years, believe it or not. That's crazy to think about, over 50 years, some companies. But you want to know how long is this company, being committed to paying a dividend? That's a big helpful thing. And also, you want to ask yourself, how often do they pay these dividends? Like I said, most companies pay them every 3 months. It's something you want to look into. Is it a regular dividend? Generally speaking, companies that pay regular dividends are very committed to keep continuing to pay those dividends over time. Companies that sometimes pay special dividends, those ones are more inconsistent. Oh, we're just going to pay you $1 this year. Oh, we're paying you $3 next year. Oh, this year we're not paying you anything. Companies that generally give dividends every 3 months, they're pretty committed, especially if they've been doing it for a long time, okay? Next question you got to ask yourself is how big is the dividend yield, okay? So it's not so much about how much money they pay you out. It's more about the yield you get back from that. For instance, so a dividend yield, basically how it's calculated is if a share price is at, let's say a share price is at $100, okay? A share price is at $100, and this company pays out $1 in dividends per year to the shareholders. That basically means that's a 1% dividend yield there, okay? If they paid out $10, because 100 divided by 10, then there would be a 10% dividend yield, which is insanely high. Most companies that do pay dividends is generally between about a 2% and about a 6% dividend yield, okay? So you want to look at the yield because that gives you more of an idea of how much you're getting back as a return as far as money coming back to you, okay? Then you want to ask, how safe is that dividend, okay? How safe is that yield? How safe is that dividend? How you figure out this is you actually focus more on the balance sheet than the income statement, okay? I like to focus more on the balance sheet to understand how safe it is, because basically, if you have a company that has a lot of cash, a lot of investments, okay, and very little short-term debt, very little long-term debt, and those kinds of things, then the likelihood that that company would cut a dividend is much lower, because it basically, if their business stumbled a bit, they're not in a big financial stress where all of a sudden they got to, cut that dividend because they need that money so bad to pay their bills, okay? Companies that, are in a situation where they got tons of debt, very low cash, very low investments, and then all of a sudden run into some troubles, the first thing they're going to cut is that dividend, because they're going to say, well, we can't afford to pay out you shareholders right now, because if we keep paying out you guys, there's going to be no money left to fund the business. And then we're going to end up going bankrupt, and then we're all going to lose our jobs, and then your investment's going to be worthless. So generally, one of the first things a company will cut, if it's in financial stress, is that dividend. However, if the company's got massive amounts of cash, massive amounts of investments, not much debt, there's going to be no real urgency to cut that dividend right away. So that's how you tell how safe it is. You look at that balance sheet. And then you got to ask, will that dividend continue to go up? You don't want to be in just a company that they're going to pay the same amount of dividend for the next 20 years. You want ones that generally will increase the dividends each year. Those are really good companies to be invested in. Some of the best companies in the world, they increase their dividends every single year. It's almost a consistent pattern. And it lets investors know that, hey, we're a safe company to invest in. We keep increasing our dividends every year. You want to be with us. We're going to pay you out more and more money every single year. So if you're invested with us in the next 20 years, your dividend's going to go up every single year, more and more, and that money's going to go up and up and up. So you got to ask, will it go up? How do you know if it will go up? Well, you got to look at the income statement. Now you got to look at the income statement, and what you really want to look at, you really want to look at revenues, and you really want to look at the bottom line, profits, okay? Gross profit, net income. Are those numbers consistently going up, okay? Now, if there's, 2 years in a row where that net income has dropped, that's a bad sign for a dividend company. That's a sign that maybe that company might cut their dividend, maybe they'll eliminate their dividend, or they might not increase it at all, okay? If they've had 2 straight years where net income's going down, okay? You want to be in companies that, generally speaking, their net income's going up and up. It doesn't have to be dramatic amounts. It doesn't have to be their net income went up 50% this year. It just has to be a consistent rise in the net income. That will let you know that there's a good likelihood that the board of directors will then up that dividend more and more, okay? So now that we kind of have these base fundamentals understanding, now I want to explain to you guys exactly how to actually build that dividend portfolio out. All right, guys, now that we have the base fundamentals understood of what dividends are, how to tell if they're safe, how to tell if they're going to go up, all those kind of good things, now we want to talk about actually building out that dividend portfolio. How would you go about building it out, okay? Well, the first thing with really building out a dividend portfolio is, if you want to build a dividend portfolio seriously, you need to be putting at least $10,000 away toward these dividends each year, okay? If you're not bringing in at least $10,000 to put into that dividend account each year, then I highly suggest you go watch some of my passive income videos, watch some of my entrepreneur videos, watch some of my, creating a side business, making money online. Go get your income up. You shouldn't really be focused on this part right now, because dividends aren't going to bring you that much money unless you have a lot of money, okay? Unless you're putting away good amounts of money each year, okay? So you should really stop watching this now and go focus on passive income, go focus on making money online, go focus on getting your income up, okay? Because here's kind of your first understanding, okay? Let's say you put $1,000 away toward dividends each year, okay? Let's say you get, a decent dividend yield is somewhere around, let's say 3% on that, okay? What's 3% of $1,000? 3% of $1,000 is 30 bucks. So you make 30 bucks in a year. That's like nothing, guys. However, let's talk about $10,000, okay? Let's say you put away $10,000, at the same 3% yield, which is not a bad dividend yield. Then you make 300 bucks. Okay, not bad. We're at least getting somewhere at this point. Now let's talk about, you got $100,000, okay? You got $100,000. Now you get that same 3%, okay? And what do? You get $3,000, okay? And then imagine $1 million, you get $30,000, okay? And then imagine $10 million, so on and so forth. So with dividends, the first thing you want to focus on before you even build a dividend portfolio is make sure you get your dang income up, okay? So like I said, go watch all my getting your income up type videos, entrepreneur passive income, because that's what you got to focus on first. But let's say you got that $10,000 plus per year to put towards stocks. Okay, great. Then we can really talk about, seriously building a dividend portfolio out here, okay? So let's say to get started, you got $30,000 in savings, okay? You got 30K, that's what you're starting with, you got 30K. So what I would do in this situation is I would find 3 great dividend companies, okay? How are they great? Well, like we talked about, they got to be safe, they got to have great balance sheets, their net income's got to be trending upward and not downward. If it's trending downward for 2 years or more, that's a very bad sign. You do not want to be involved with dividend companies like that. You want them generally to pay a 3% yield or more. You can maybe go down to 2% if that company has net income going up quite a bit and if they just have such a phenomenal balance sheet. But generally speaking, you want like a dividend yield of 3% or more, okay? So if I had 30K, here's how I would do it to start, 30K. So I would put 10K in whatever I felt was the safest, the best, my favorite dividend paying stock, okay? I'd put 10K in that one. Let's say this one pays a 3% yield, all right? 3% yield. I put another 10K in one that already pays a pretty high yield, but maybe they're not going to increase it a lot. A lot of pharmaceutical companies kind of fit this mold. Oil and gas companies used to kind of fit this mold until oil got so weak over the last few years. But a lot of those companies will pay a 5 or 6% yield. So let's say this one pays a 6% yield. Awesome, okay. And then I want to put the rest of my money in a company that I feel like is probably going to aggressively pay out more dividends in the future. A company like my Wynn Resorts position would probably meet that criteria. They've spent so much money on building the new Wynn Palace that's now, providing so much results that they're going to end up throwing off tons of net income over the next few years. So I would say Wynn would be probably a company that very high likelihood of them paying out much higher dividends in 2018, 2019, 2020 versus this past year, unless the whole economy goes in shambles and everybody's in trouble, right? So that's the type of company I'm trying to find. Maybe an Apple. Apple's a company that could aggressively raise that dividend over the next few years because of the way their net income's now starting to go up, and the fact that they have such a low payout ratio, and the fact that they have insane amounts of money on their balance sheet. But let's say this company pays, kind of a lower yield at the moment. Maybe they pay like a 2%. Okay, that's fine. We can deal with that. So basically, over the course of this year, this one would make me about $200. All right. This one would make me about $600 in the year. $600 profit. And this one here would make me about $300. All right. So net, I make about $1,100 in income in that particular year. All right. $1,100 in dividend income. Now, what do I do with this $1,100? Do I go, spend it on a new MacBook, or do I go buy the new iPhone 10 with that? Absolutely not. I'm going to reinvest that dividend money. Now, so for this next year, I got another 10K coming down here. So now I find another stock. Okay. So then I found another stock that's probably at another 3% yield. Plus, I put this $11,000 into that stock. So instead of 10K, it's actually 11,000. Okay, it's actually 11,100. All right. We'll put 11.1 there, 11.1K now, and we're getting another 3% yield, okay? So now we got this one bringing us a return as well. So now this one's gonna end up bringing us, more than $300. So we're gonna have more income coming here, and then you do the same thing the next year, and you build out another one, and then all of a sudden you got a, 12.2 or 12.3K, one there. And mind you, here's the beautiful thing. The good chances are this one has now raised their dividend yield from a 2 to probably a 3% yield, right? Or if it's not yield, then that means the stock went up, which is also good for you, right? Because that means your shares appreciated, which is freaking phenomenal. And the good chance this one, the dividend went up as well. So maybe now instead of them paying you 50 cents a year, maybe they're paying you 75 cents or something like that, guys. So these yields actually go up. Maybe this one doesn't, because this was kind of the one that was already bigger, that they can't really grow that much because they're not really a growing company too much. But these ones, the yields probably went up. Then all of a sudden this yield went up. Okay, and then as the years go on, all these yields are getting bigger and bigger and bigger as long as the business is getting better, right? And then hopefully on top of that, the shares are appreciating over time. If they keep raising their dividends, right, that means their net income's probably, generally speaking, going up, which if their net income's going up, then that share price, generally speaking, has to follow. So then all your shares are worth more. So instead of having 10K in this stock, it's all of a sudden worth 11K, 12K, 13K. Same thing with this one, and this one. So that is truly how you want to build a dividend portfolio. You want to make it diversified. You want to start getting that money in. Then you want to reinvest it and then keep funneling that income down here, or keep funneling, what you have for income down here and get it down there. But the whole key with building a dividend portfolio is you really got to be putting off at least 10K plus a year that you can put toward investments. If you're not, you just got to focus on getting your money up for now, because you can see you're not going to make crap off dividends. If you got little amounts of money in the market, you're really not, unless you invest in some insanely high paying dividend companies that pay like 15-20% yields. But a lot of times, guys, those are extremely risky. Those are extremely risky type companies. Sometimes they're taking out loans just to pay that dividend. Sometimes they're doing some quirky financial stuff in the accounting board that could potentially get them in trouble. There's a lot of those super high yielding companies are extremely dangerous to invest in, guys. So beware of those. Like, I remember when I was a young investor, my first year, like I would see, such and such stock, they pay an 18% dividend yield. Wow, I should stick money in that. And then you really start digging through the financials and you're like, dude, this is not good at all. This company is so not good. So stay away from those guys, those ones, guys. I hope you absolutely enjoyed this. I hope you enjoyed this. If you got a lot of value out of this today, hit that thumbs up button. If you want, join my stock market membership group. You guys will get so much value out of that. That is insane. It is linked there. The first thing linked in the description. Thank you for watching, guys, and have a great day.